Welcome to a mortgage edition of A Realty Vision. We're here with Steve Campbell today, and he's going to teach us a little bit about what a FICO score is. So first of all, how are you doing today, Steve?
I'm doing fine. Thanks, Erin.
And what is a FICO score?
A FICO score is a number used to assess risk based on the credit history of any particular borrower.
Okay. And, in terms of risk and all that type of thing, now, what is FICO in general? Like, where did FICO come from?
About 60 years ago, TRW went to a statistical company, Fair Isaacs and Company. That's FICO. And what they wanted was a numerical score that would be used to determine whether or not somebody would be 90 days late within the next 24 months. They reviewed over 1.5 million files and looking for patterns within those files to help depict that score. The score is based on those patterns. It's like a picture of a moment in time. Your score could be high at one point of the year and low at the next, depending on your activity within your trade lines. The score itself ranges from 850 to 350, and there are multiple facets and patterns that they found that impact your score.
Now, talking about patterns that affect the score, now, how do they determine what patterns affect the score and encompass the score altogether? Like, what determines the score?
Okay, well, there are certain patterns they found, and each one of them affects your score by a specific percentage. 35% of the score is based on how you pay your bills. That's late payments. 30% of the score is based on the amount you owe on each account. In this area, the number one killer is the percentage of revolving debt. In a lot of cases, what will impact you negatively is having a high balance, a maxed out credit card or 2 or 3. Those are going to have the potential to impact you negatively. Even though you've made the payments on time, you can still have a negative impact to your FICO score by carrying high balances. Ideally, the Fair Isaacs Company wants to see 50% or less of the high credit limit in revolving debt. That has the potential to raise your score. And this is where you can have the most impact when looking to get a mortgage. When you're coming into that part of the mortgage, you can pay some of those trade lines down and have the potential to positively impact your score before qualifying.
Now, tell me a little bit more about the other percentages involved with your FICO score.
15% of the score is based on your credit history. Long. Credit history is assumed to be 30 years, which is defined as a person who knows how to handle their debt. A majority of the people who apply for credit type accounts don't have 30 years worth of credit, and FICO knows this. That's why they determine your credit history on the amount of revolving accounts that you have versus the duration of time you've had them. 3 to 5 years is a very positive duration of time to FICO.
I've always sort of had the idea that to have your credit checked a lot was deemed negative. Is that true?
Yes, it can have a negative impact. In fact, 10% of the score is based on new inquiries. If a finance company inquires, then an auto company, then an insurance company, your score will go down. Now, it's interesting to note that if a mortgage company and then another mortgage company and then another mortgage company pulls your credit, FICO recognizes and it will not hurt your score for shopping for a mortgage. In fact, a mortgage inquiry only shows up new for up to 30 days. And then FICO looks back 14 days for a mortgage inquiry. If you do a second inquiry within 14 days, the earlier one will be eliminated and the new one will show up as your only inquiry.
Okay, and a final note, Steve. What exactly is it that you want to say to our audience to cap this off and really put a closing thought on what we've learned today about the FICO score?
Well, some of the stuff in the segment today kind of gave some uncommon knowledge to the typical person out there who wants to know what it takes to obtain and maintain a high credit score. It's one of the things that can help them save thousands of dollars when applying for a mortgage loan. Anybody out there who's interested in more, I urge you to please give me a call and we can take a look at what you qualify for yourself and how we might be able to improve on that.
And I'm so happy that we talked today. Thanks so much, Steve.